Hello everyone, this is Andrew McNair from SWAN Capital with our November 2023 SWAN report. In this month's video, we're going to discuss some recent headlines that influence the financial markets. But I want to distill all of this information, all of the news that you're hearing, into developments that you need to know about that can affect your portfolio, affect your retirement plan. Now, as always, please stay tuned at the end of this video for a required disclosure statement. At SWAN Capital, our market outlook does remain cautious because of world conflicts and higher consumer credit, as well as this inflation that is so stubborn. Experts were saying that third quarter GDP, or gross domestic product, would be strong. But just how strong was a surprise, coming in at an eye-popping 4.9%. Where did all this growth come from, and will it continue is the big question. If you look at third quarter growth, the GDP growth came mostly from personal consumption. That's basically individuals like yourself, like me, buying things, inventories, and government purchases. Other components of GDP were little changed. Personal consumption growth shouldn't surprise anyone. In fact, personal consumption expenditures, or PCE, is a key inflation metric for the Federal Reserve that they keep a close eye on. PCE didn't drop from last month's levels, which tells us inflation is stubbornly hanging around. And just because inflation is slowing down doesn't mean that inflation from years past has been eroded or gone away with. If you've been on an airplane or in a hotel or restaurant this year, it's obvious people are spending. But savings are sadly diminishing. Credit card bills are piling up, and interest rates to service that debt have risen to levels not seen in over 30 years. Everything also costs more, so you have to spend more to consume the same amount. Plus, student loan repayments have resumed, so people now have less money to spend. So this ramp up in GDP growth may not be far-lived and far long-lived for much longer. The argument that all this pent-up demand from the pandemic is driving this growth is getting long in the tooth and will expire. At some point, we either will be exhausted from spending or running out of money. This pace of travel and leisure cannot be sustained. After the last Fed meeting, interest rates will stay where they are. Markets took a deep breath and focused on comments from the Federal Reserve officials. First, we heard from Michelle Bowman, who said that she expects further tightening will be needed, which caused markets to initially tumble before rebounding. Later the same week, Chairman Jerome Powell stepped up to the mic and got all Eeyore on us. This is the same guy who said the week before that the Fed was waiting to see what the data would say. He didn't see any new data in the days between comments, and he said monetary policy is in restrictive territory, and the Fed would need to not be misled by a few months of good data. Now, wonder what he would say if we had a few months of really bad data that may change his mind. And markets freaked out after his comments that really shattered the fragile narrative that the Fed was done increasing interest rates, and that we would start looking for signs of decreasing rates. However, following these comments, CPI inflation was flat in October from the previous month before, providing a really hopeful sign that stubbornly high prices are easing their grip on the U.S. economy. This led the markets to rally following the news on hopes that the Fed would finally press the brakes, that they would stop increasing interest rates. And again, millennials and Gen Zs have to wake up that interest rates will not go back to where they were. It may take decades before that happens. Now, attention market timers. If you need yet another reminder of why trying to time the market is a no-win situation, just look no further than 2023. As of November 14th, the S&P 500 was up 17% year-to-date. However, most of the gains can be attributed to only 8 days. Who is confident enough in their skills to have predicted which 8 days you would need to be in the markets to capture these gains? It's similar to how a narrow set of securities accounted for the lion's shares of returns that we've seen recently, which is what we're keeping a really close eye on because that's not a good thing. Would any timers have been wise enough to select the 7 securities ahead of time while living with the corresponding volatility? Of course not. The truth is, timing the markets and concentrating on individual securities is not a good game. It is a dangerous game. The S&P 500 has posted a positive return nearly 75% of the time, and that's a lot less stress and hand-wringing. Have you ever seen a coach who wins 3 out of 4 games and gets fired? Of course not. Or a baseball player whose batting average is .75. Not getting into the Hall of Fame? Yeah, right. Spoiler alert, there has never been a Hall of Fame member with a batting average higher than Ty Cobb's at .366. You get the point. Time in the markets, it's not timing the markets, is usually an effective approach to working towards consistent results for investors trying to reach their goals. That's going to be it for this month's SWAN report. But if you have questions about your retirement plan, you have questions about your portfolio, I want to encourage you to take us up on a 1-hour complimentary discovery visit to get the second opinion that you're looking for. And all you have to do is call 1-800-848-8768. That's 1-800-848-8768. I want to thank you for listening to this month's SWAN report, and we'll see you next month.